Hey everyone, and welcome. If you're prepping for your Strategic Business Reporting exam, your SBR exam, then you already know how critical it is to stay on top of the latest standards. So in this explainer, we're going to break down one of the biggest updates we've seen in years, IFRS 18. And we're going to focus on exactly what you need to know to nail those professional skills marks.
So, let's kick things off with a really big question. When you're looking at a set of financial statements, how do you know you're getting the real story about a company's performance? You know, the actual unvarnished truth? Or are you just seeing the story that management wants you to see? For years, telling the difference between the two has been a huge challenge for analysts. But well, all that is about to change.
And that brings us to our focus today, IFRS 18. Honestly, the best way to think about it is like a brand new architectural blueprint for the profit and loss statement. It's all about bringing structure, discipline, and a whole lot of clarity to an area that, let's face it, could often be pretty inconsistent. For your SBR exam, getting your head around this new blueprint isn't just a good idea, it's absolutely non-negotiable.
So here's what we're going to tackle in the next few minutes. We'll cover 3 essential areas for your exam. First up, we'll walk through the new mandatory categories that are now required in the P&L. Then, we're going to decode what are called management-defined performance measures to figure out what management is really trying to tell us. And finally, we are going to clear up that critical and sometimes confusing distinction within other comprehensive income, or OCI.
All right, let's dive into our first key area. You see, IFRS 18 isn't just making a few friendly suggestions. It's enforcing a totally new mandatory structure. This is a massive shift in how performance gets presented. And for us as analysts, it's honestly a gift. So here it is, the new structure. Every single income statement that follows IFRS now has to be organized into these 3 categories. Operating is, the main business, what the company actually does. Investing is going to include income and expenses from assets that aren't part of those core operations. Think things like the profit on selling a subsidiary. And financing, well, that's all about the costs of raising capital. Now, for your exam, the real key is understanding the judgments behind the classifications. For example, interest received. That could be operating for a bank, but it would be investing for a manufacturer. It's that kind of application of principles, not just memorizing the rules. That's going to earn you the big marks.
And you've got to understand the why behind this change. This new structure isn't just about shuffling lines around on a page. It's about forcing comparability. It allows an analyst or an SBR candidate like you to compare the core operations of Company A against Company B on a true like-for-like basis. It strips away all the noise from their different financing or investment choices, and that gives us a much stronger foundation for our analysis.
Okay, let's move on to our next section, which is all about learning to see beyond the standard numbers. This is where your professional skepticism, a skill that's tested all over the SBR exam, really gets to shine. We're talking about those custom-made numbers that management teams just love to put front and center.
The official term for these is Management-Defined Performance Measures, or MPMs, but you'll probably know them better as non-GAAP measures. We're talking about things like adjusted EBITDA or core earnings. Essentially, they're subtotals that management creates to push a particular story about performance, and they often do it by excluding items they say are one-offs to make their earnings trend look a bit smoother. The big problem up until now is that there were no consistent rules for how these were presented.
And this leads us to the most important question for any analyst. Does this mean management can just make up any number they feel like? Can they just exclude all the bad stuff and call the result profit? Now, they might argue there are good commercial reasons for it, but the potential to mislead investors is huge, and IFRS 18 tackles this issue head-on.
And this is where IFRS 18 steps in with a really simple but incredibly powerful new rule. I like to call it the reconciliation bridge. It creates a mandatory, totally transparent link between the story management wants to tell and the story told by the official IFRS standards. And here's the rule. It's critical. If a company decides to show one of its custom MPMs, it now must include a reconciliation in the notes, showing step-by-step how they got from an official IFRS number to their own number. For the SBR exam, your job is to put that bridge under a microscope. What exactly do they exclude? Are they always excluding restructuring costs but conveniently keeping in one-off gains? Does their reasoning actually make sense when you look at it skeptically? This is where you really get to demonstrate professional judgment. Okay, let's tackle our final topic, and I know this is one that can be a real headache for students: other comprehensive income. Now, IFRS 18 doesn't actually change the accounting for OCI, but it does demand much clearer presentation, and that's exactly why mastering this distinction is so important for your exam.
So first things first, why should we even care about OCI? Well, it's because the P&L doesn't actually tell the whole story of how a company's value has changed. OCI is where we see other really big changes in a company's net assets, things like gains on property revaluations that aren't considered part of that year's profit. If you want a complete analysis, ignoring OCI is kind of like reading only half the book.
So the key distinction that IFRS 18 really shines a spotlight on is the split between two types of OCI. Recyclable items, like gains on cash flow hedges, are basically sitting in OCI temporarily. They're waiting in the wings before they get moved or recycled into the P&L in a future year. On the other hand, non-recyclable items, like a revaluation surplus on a building, will never hit the P&L. They adjust equity directly, and that's it. The insight here for an analyst is huge. Recyclable items can be a clue to future reported profits, whereas non-recyclable items tell you about a much more permanent change to the company's net assets.
So, let's pull all of this together. What does all this mean for you right now studying for your SBR exam? How do you actually turn this technical stuff into a real analytical edge that's going to impress the examiners?
Here's the bottom line. IFRS 18 matters because it hands you a more structured, more comparable framework to do real-world analysis. It forces management to be transparent about their custom numbers, giving you the evidence you need to challenge their story. It makes the nature of OCI crystal clear, helping you see the difference between temporary value shifts and permanent ones. And at the end of the day, the SBR exam isn't about just repeating rules. It's about applying your professional judgment, and IFRS 18 gives you so much more to judge.
So I'm going to leave you with this final thought. The new rules in IFRS 18, they give you a clearer map and much better tools. But a map is only ever as good as the person reading it. The real test for you, as a future professional, isn't just knowing the rules. It's about using those rules to look past the numbers on the page and uncover the true story of a company's performance. That's the real challenge. And that right there is your edge.